Hi, friends and short term rental investors. Have you heard about the short term rental tax loophole? This is a legitimate tax reduction technique. And at the end of this video, I'll explain 4 traps the IRS would love to catch you doing. So stick around. So today I wanted to break down the loophole. It's not really a tax loophole in the traditional sense, it is an actual tax law. And there are 2 rules that make or break this and why depreciation is the engine behind it, and the common mistakes that get made by investors that get them in trouble. And I'm going to keep it in plain English, no tax jargon stuff. I hope this helps. So here's the truth, it's not some cheat code, it's a set of actual IRS rules that can let some short term rental owners use deductions in a way most long term landlords can't. But you got to qualify, and most people skip that part that matters. First, we need to discuss why the long term rentals usually don't help your W 2 taxes. Here's a normal situation: most rental real estate is considered passive activity for tax purposes. And that's important because passive losses generally don't offset your W 2 income or any other active income. So a lot of landlords ended up with losses they can't really fully use right away. They get carried forward losses, or they only count against the passive income. That's been the standard traditional way for decades. So now here's what the short-term rental loophole comes into play. If your property operates like a short term rental business, the IRS can treat it differently than, say, a typical long term rental. The big threshold investors talk about is the average guest stay has to be 7 days or less. So each guest has to stay 7 days or less. When you're under that, the activity may be treated more like a business operation than a rental, and that's the key. But that alone is not this loophole. The second requirement is the real gatekeeper in this, it's the material participation. So, what that means is you actually are involved in running the day to day business, not just collecting the rent checks. Has everybody got that? You got to be materially participating. And that's key in the IRS code. So, examples of material participation activities can include guest messaging and problem solving, um, managing booking and pricing, coordinating the cleaners and turnover, buying supplies, scheduling repairs, and handling, say, vendor relationships, if there's things that need to be done. So the true loophole is short average stays of 7 days or less, and you materially participate. The activity may not be non passive. I know that's a contradiction. If it is non-passive, then those losses may be usable against other income depending on overall situation. So now let's talk about the part that makes people excited, and that's depreciation. Depreciation is a non-cash expense. Your property might be cash flowing, but depreciation can show a tax loss on paper. We're getting into the weeds a little bit here, but some investors can accelerate that depreciation with what's called cost segregation, breaking the property into components that depreciate faster than the standard depreciation. And then there's bonus depreciation. When available, you can use that also under current law. That's why you'll see investors say things like, my short term rental made money and I still paid less in taxes than a long term rental. It's usually because of this depreciation, especially the accelerated depreciation, creates deductions that reduce the actual taxable income. You don't get the benefit just because you own an Airbnb. These rules are very specific. So let's do a simplified example. Say you buy a short-term rental, and after expenses, you net $10,000 in cash flow. But between depreciation and possibly accelerated depreciation, depending on your plan, the property shows a $25,000 tax loss on paper. So, if the activity qualifies as non passive, your stays are short 7 days or less, and you materially participate, the loss may potentially offset all of that income depending on your personal tax picture. So that's the loophole. So, this is what investors chase when they think about long term rentals versus short term rentals. But here's the part nobody likes to say out loud. If you don't qualify, those losses may be treated as passive and not do what you thought they would do. So be very, very careful. Now, the warning label about potential traps, because this is where people mess up. So pay close attention. Trap number one. You used a property manager and barely do anything. If you outsource everything and your involvement is minimal, you may not materially participate, and that can kill this strategy. And the IRS is very particular about what material participation is. Trap number two, your documentation is weak. If you're claiming material participation, please, please, please keep records. Not vibes, but records. Calendar entries, task logs, vendor invoices, messaging history, whatever shows that you were materially involved in the property. Trap number three. Trap number three is you treat it like a one size fits all hack. Tax strategy depends on your income type, your household situation, your other investments, and how the property is actually run. Two investors can own identical rental properties and get completely different outcomes. So check with your tax specialist, your CPA, your tax attorney, whatever. Trap number four, you ignore local short term rental rules. Now, this is something that a lot of people forget about, and that is a city can destroy your short term rental plan overnight with restrictions, with permits, enforcement, or other short term rental bans. If the business model isn't stable, the tax strategy doesn't even matter. So, bottom line, the short term rental tax loophole is really about how the IRS classifies the activity and whether you materially participate in that activity. And then you can use the depreciation strategy. So, if you found this helpful, please like, follow, subscribe. It really helps the channel. And I know that we went through this pretty quickly. Check with your CPA. Now for my disclaimer. I'm creating this video only as a general education purpose and does not I'm not providing legal, tax, or accounting advice. Tax outcomes depend on your specific facts and tax laws, and the interpretations can change. Before acting on anything we discussed today, consult a qualified CPA or tax attorney who can review your specific situation. Remember, it depends on your specific situation. So I hope this was helpful. I hope that you guys can take advantage of this tax loophole, even though it's not really a loophole, it's actually codified in the IRS rules. And consult with your CPA or your tax attorney on everything. And be very specific with them about what your tax situation is, what you want to do with the property, and make sure you also check those local laws and regulations, because those can also have an effect on the outcome. All right. I hope that helps everybody. Again, please like, comment, and subscribe, or follow and subscribe. It really helps the channel, and I hope to see you guys soon. All right. Talk to you later. Bye-bye.